There we are. And as people roll in, I will allow them in. And Dylan's here to check on any questions that we have in chat and Q&A, and we'll go forward from there. Okay.
Okay, perfect.
All righty. I'm going to share my screen for right now to start. And again, I wanted to thank everyone for being here for our webinar today. Thanks for joining us. And again, for compliance reasons, this is being recorded. I'm Todd Pouliot with Gateway Financial, and my job here is very simple, to introduce Christina and have her share the knowledge with you that she has. I think it was maybe November of 2020 when I saw her first present this today, and I thought it was impactful because I think when we talk about credit, we talk about the things that we can control and we can't control a lot. And we can't control what happened in 2022 with the market, but we can control our credit score if we have knowledge. So I think the title of this, Understanding and Improving Your Credit, is going to be a lot of the knowledge that Christina is going to bring to us. One of the things that I think when we share what we do is we share where we're at and how visible we are. Obviously, you can find us on our website, mygatewaymoney.com, but we're also members of the Fee Only Network, National Association of Personal Financial Advisors, XY Planning Network. You can find us in the news, as you can see here. Feel free to join us at any of those areas. And mostly I'd like to maybe focus on that one line about charity work. My wife and I do a lot of work with the Cystic Fibrosis Foundation. And before we started this webinar today, Christina and I were talking, and just a wonderful soccer career she had. If she'd like to take some moments to share those with you, she can. Also on our website, you can also find over 100 flow charts and checklists. And the one thing I think when people get on these webinars is they go, oh no, another financial advisor. Well, we don't like to use that term around here a whole lot. We like to use the term financial planning. Again, this is not a sales webinar. This is an education webinar. But just for our quick commercial, we have tax planning and financial planning, along with tax preparation, estate planning and administration. And again, I think people really appreciate the 24/7, 365 client portal access that they have. So one of the things that I also like to talk about is we are different. We are a fee-only financial planning firm. We do not accept any commissions here. People are always like, why are you working together with this wonderful company, Prudential, The Rock? Aren't they an insurance company and pay commissions? Well, they have offerings on both sides, and deciding what to do is the right thing to do. And that's when being a fiduciary comes in for you. So again, we're fee only. We're a full-time fiduciary. We do not play both sides of the table. We only sit on our client side of the table. We only allow them to pay us directly. Our clients are our shareholders. That's it. Those are the only people that we answer to. And we are wholly independent. We are partnering today with Prudential to offer this webinar to you as an educational purposes, but we are not affiliated with any brokerage firm, bank, or insurance company. Again, our clients are our shareholders. So I'd like to introduce Christine to you. She's going to go through the agenda. And Christine, let me make sure that you have the sharing capabilities here, and I will launch that out to you, and you can start your slide. Go ahead.
Awesome. Thank you so much, Todd, for the introduction and also for inviting me on the call here today. We are excited to be able to go through this content. And as you mentioned, you had the opportunity to actually see this content live in November. And personally, I enjoy giving this presentation to clients more than advisors. Not to say that advisors aren't great, but I do think that clients get a lot of education out of this presentation. And the reason I love to deliver this to clients is because there's really not a lot of places that you can go to really get this type of information. Of course, you can do some Google searches and you can read a ton of different articles, but there's really not any one main location that really goes through the ins and outs of credit and really explains what that means to you as the consumer for your individual personal basis. And so what we really wanted to cover within this presentation was to make sure that you knew everything that there was to know about your credit score, and you had all of the tools and resources you needed in order to potentially work to increase that score, in order to potentially work to keep that score high, or even just to be able to educate any of your younger kids or grandkids as to how they might be able to build their credit as well. So what we're going to go through here today is first an introduction of credit, right? What is credit? Where did it come from? And why does it matter to me? Then we're going to talk about how you can read your credit report. These credit reports are very long. There's a lot of different items on there. So we're really going to kind of cut through that noise, explain why there might be different reports and how you might be able to access and utilize the different credit reports that you have. Then we're going to go through a number of different strategies as to how you might be able to increase your credit score. Now, I am going to caveat that and say there really is no silver bullet for your credit score, right? This is going to be a slower process over time to increase your score. There's nothing you can do to increase it, 150 points overnight. But if you start to implement really good habits within your financial life, what you'll notice is that your score will slowly rise and continue to rise over time. And so what we say is if you commit, 6 months to a year, maybe 2 years, depending upon your situation, you could really come out of any hole that you might feel that you're in. I also am going to cover some different items about where the rest of us are when it comes to credit. I think there is a huge and a ton of misconceptions about your credit, how it's calculated, and whether or not your score matters, right? And so what we're going to talk about here are all of the different ways as well that we can lower our score in hopes so we can avoid some of those common pitfalls as well. And then if we have time, we are going to talk about the future of credit. We probably will only spend a couple of minutes there, but they are discussing making some changes to how they're calculating our credit score. They haven't yet done so, and we might not see a big change in the short term, but it is good to know that they are constantly looking at this and constantly looking at how to make it more consumer friendly for us with these updates. So with that, what I'm going to do is I'm going to jump in. And the first item here is your introduction to credit. And really what this is it's the difference between the two types of credit that we have. So consumer credit is really just personal debt that we've taken on to purchase goods and services. And there's really two types of consumer credit. The first is installment credit. So these are items with
Christine, I don't mean to interrupt you, but your slides are not showing. Oh, I see them. They just popped up for me. Thank you.
Okay. No. Perfect. Yep. Good. I was like, woo. Okay. So the first type of credit is installment credit. And again, these are payments that have a fixed payment for a fixed period of time. So a great example of this could be your mortgage, right? You have a 20-year mortgage and your payment each and every single month over those 20 years. Now, revolving credit is a little bit different. Revolving credit means that you're not required to pay the full amount each month, and the amount typically changes. So think of your credit cards or your retail cards, where depending upon how much you're spending on those cards really depends on how much that minimum payment is and versus how long it's going to take you to pay that card off, right? So revolving credit means that you're constantly adding, it could be changing, the amount might be different, the length of payoff could change, whereas installment is really going to be more fixed. You're going to know the exact amount that you have to pay every single month, and it's not going to change unless you make changes to that debt agreement. So those are really the two main types of credit, and we'll talk about both in detail as we go through the presentation here. But first, I really want to get into a couple of items when it comes to credit. And the first is the Fair Credit Reporting Act of 1970. Now, the Fair Credit Reporting Act is an act that was designed to protect us as consumers, to protect us from the lenders. And this really has a lot of protections for consumers in place. And on the next slide, I'm actually going to go through some of those protections because it's really important for each and every single one of us to know our rights and know or be able to recognize if a particular company or if a particular person is not following the rights that you have under the Fair Credit Reporting Act. We also know that in 1989, they adopted a new credit scoring system. And that's where our credit score came from, right? The 3 digits that you are all familiar with, right? And what we're going to talk about for the majority of this presentation is going to be your FICO score. Now, we're going to discuss your FICO score specifically because it's used in over 90% of all lending decisions. But it is important to know that your FICO score isn't the only credit score that you have. There are multiple different scoring agencies. Another popular one is called Vantage, which will also give you a different type of credit score. And the important thing to know about your credit score is that it is a 3-digit value that is derived from the information on your credit report. So we know that we have different credit scores, right? We have the FICO one, we have the Advantage one. Really, what they're both doing is they're evaluating your credit report. And there's just a different algorithm for each that spits out a 3-digit number, which again is your credit score. Now, your credit score is going to range from 300 all the way up to 850. Now, ideally, you'd want to be in the good or excellent range, but we can also give you some pointers and tips in case you do fall into the fair or bad range. Now, as we continue here, I want to just take some time to really discuss the rights that you have. It's really important for clients to know all of the rights they have under the Fair Credit Reporting Act. So I'm just really going to read these off to you. First, you have the right to know what your file contains. If there's something in that report, you absolutely have access to it. There should never be any reason why someone tells you you were denied credit without telling you exactly why or what information they used in order to make that decision. You have the right to ask for your credit report, and we'll talk about that in more detail. You have the right to dispute information in your credit report, and this is the biggest one. If there is something on your credit report that maybe is inaccurate, or maybe it's not the way the situation unfolded, or maybe it could honestly just be fraud, you have the right to have any of that information removed, and there's a process to start that reconciliation right on your credit report. You have the right to have inaccurate information corrected or removed. And really, those two items have to do with different types of payments. So, for example, if you opened up a credit card and maybe they were mailing your bills to the wrong address, that might go in under as a missed payment, but you have the right to say, yes, but they weren't sending the bills directly to my address. As soon as I got the bill, I paid it immediately, right? And they will go to that company and they will say, is this true? If that's true, they would potentially remove that from your credit report. So if you see any negative items on there, don't be afraid to contest them, right? It doesn't cost you anything. It will have no negative impact on your credit. The only positive outcome would be that they agree with you and they remove the items on there. So again, make sure that you are taking a look. Any negative marks on your credit report, make sure you know exactly what they're for. And I would encourage you to dispute them regardless of whether they remove them or not, right? Though, like I said, the worst that could happen is they'll say, no, it stays on there, right? The best case scenario is it's removed and it helps increase your score. The last three here, you have the right to older negative information being excluded. So this is really covering any bankruptcies that you might have filed or any negative remarks. They're only impacting your credit score for a certain period of time, depending upon what that event is. And we'll give you the list for those as well. You have the right to access your credit report or limit who has access to it. So if you don't want someone pulling your credit report, they would not have the right to do that. And then lastly, you can have your employer pull your credit report as well, only with your consent. If you don't want them to pull, they do not have to. There is a caveat to that. Certain positions, so financial positions, for example, you would have to agree to let them pull your credit report. I believe there are some other careers as well where you don't have the option. The employer just won't offer you the job unless they can see that. So just be aware, but they still would need your permission to pull that credit report. So with that, now that we know our rights, let's really jump into how our score is calculated and how we can view our credit report. So there are more than 3 scores. And the reason for that is because as it stands today, we have 3 major credit bureaus. And you might be familiar with these credit bureaus. It's TransUnion, Experian, and Equifax. Now, there are also more credit bureaus, but these are really just the 3 main ones. And each of these credit bureaus is going to have their own credit report. Now, we would assume that all of them would have the same exact credit report. However, that's not always the case, right? Certain lines of credit are reported to certain credit unions. Certain companies only report to 2 or 3 out of those credit unions. And so more than likely, you are going to see differences in your scores from TransUnion, from Experian, and Equifax. Now, those differences really shouldn't be large, right? A couple of points here and there. If you're seeing massive differences, then more than likely you might need to intervene and you might need to get a specific company to report to whatever credit bureau they maybe hadn't reported that information to. But be aware, because this is a common misconception where you will go and you'll pull your TransUnion report. Maybe a month later, you'll pull your Experian report and they're different. And you think that something has changed within that month. And realistically, more than likely it hasn't. It's just you're pulling it from a different source. The algorithm is slightly different. And so it's populating a slightly different number. And what I mean by this is there are also different FICO scores. So along with the 3 bureaus, there's also 65 different FICO scores. And they do this so that when you're taking out loans for specific items, it's more favorable, right? So they have a mortgage FICO score. They have a auto FICO score. They have a retail loan FICO score, right? So depending upon what you're trying to borrow will be what they're weighting as far as that score is concerned. So again, if you go into a car dealership and they tell you your credit score is 800, and then you go into a bank and they tell you that your credit score is 785, right? Again, those are going to be common instances that you can see because they're using different FICO scores to determine what your credit score is. And also moving forward, it really depends on the dates that you pull your credit report as well, right? We know that your credit can potentially change on a daily basis. And so if you're pulling it every 3 months, I would expect to see that it's shifting here and there, right? Maybe you're paying down some debt, so it's increasing. Maybe you recently took out more debt. Maybe your credit cards are higher or lower this month than they were the previous month. And as we get into what makes up your credit scores, it will make a little bit more sense as to why the day in which you pull your credit will have an impact on those scores. We also know, again, there's different models. There's dozens of different models. There's 65 FICO scores alone. There's Advantage. There's a ton of them out there. And again, we also have different reports. So don't be alarmed if you see slightly different scores. That is completely normal. And that is because we are getting all of this different information from multiple different places. And I know some of you might be thinking, well, wow, it might be easier if they just had one score in one place so that I could track this. And I might agree with that, but I do think as consumers, the diversification of companies and models actually benefits us and doesn't give any one company a large amount of influence within this sphere. So I think the different models are actually beneficial to us as consumers. Okay, let's talk about what is included in our credit score. There are 5 components that make up your credit score, and they each hold a different amount of weight in that score. The item that weighs the most is going to be your payment history at 35%. And I don't think this is really a shock to anyone, right? We know that in order to have a good, solid credit score, we must be able to pay our bills on time. The next item here is going to be amounts owed. And that's really just going to be your total debt, right? So how much debt are you carrying? This is also sometimes called credit utilization, right? So how much of your available credit are you using? And we'll get into a little bit more detail further on in the presentation. But essentially, this is really how much debt are you carrying at any one given point in time. Now, the next item at 15% is your length of credit history. How long have you been eligible for credit? Most of us were eligible for credit at 18, but keep in mind, it doesn't start until you open that first credit account. So if you don't open your first credit card until 19 or 22, that's going to be when your length of credit history starts. So again, most of us, it starts at 18, but that's not going to be the same for each and every single one of us. So just be aware. Then the last two at 10% are new credit, which is how often do you apply for new credit cards? And the last one at 10%, your credit mix, right? So what is that mix of credit? Is it a student loan? Is it a car loan? Is it a mortgage? Is it credit cards, right? How are you dispersing that debt? Now, a couple of items that are not included in your FICO score, which a lot of us tend to think that they are. The first is going to be income, bank balances, and employment status. It doesn't matter how much you make. It doesn't matter if you have a job or don't have a job. And it doesn't matter how much cash you have in your bank account. If you don't pay your bills on time, you are going to see your credit score drop. And so a very common misconception is that, well, if you have a bad credit score, that means you don't have a lot of money, right? You don't have money to pay your bills. And that could not be further from the truth. I promise you, there are millionaires out there with a 300 credit score. And the reason for that is because they're just not focusing on paying their bills on time. The most important thing is to pay your bills on time. You don't get any wiggle room just because you had the money to pay those bills. If they don't get there on time, it's going to be a negative for you. Your marital status also has no impact on your credit score. Once you get married, yes, your joint accounts will have an impact on both of you individually. But when you get married, you don't take on your spouse's credit, right? If everything still is separate, then everything still is separate. It's not until you start combining joint accounts that your partner's credit would ever impact yours. The last is your debit card usage. Your debit card, although it's plastic, is similar to using cash. So in that sense, you're not really borrowing money. You're just actually spending the money that's in your personal account. And so because of that, it is not a factor in your credit score. And then we have age with an exclamation point, because there's really two caveats for this. The first is, again, the age you are at which you start to take on your first credit card. And that could vary from person to person. Also, where this happens is if you are someone that's closing out older lines of credit. So maybe you have a credit card from 20 years ago. The balance has been zero. You've never used it. You just want to cut it up. You don't want to risk any type of identity theft or anything along those lines. Well, you just have to be careful, because closing older lines of credit could reset your length of credit history. So you almost want to keep that first account open forever, unless you open multiple at age 18. We're going to get into a better example of this, but just wanted to go through some of those common misconceptions here as well. The next thing I want to go through is really the state of the nation, right? Where is everyone else in relation to their credit score? And does it matter where you live as far as your credit score is concerned? So the average FICO score in the US hit an all-time high in 2019, rising to 703. Now, I know we're in 2023 and that seems like an old stat, But the reason I wanted to include it is because it really is incredible how our credit score increased during the middle of a pandemic, right? And they actually equate this increase to us staying home. They equate this increase, one, of course, to the government spending, so giving us some extra money here and there to pay towards our bills. The fact that we were all home, we had more time, we had more ability to be on top of paying these bills on time. And then the third is we were spending less, right? We were spending less eating out, spending less on gas, spending less on all of these things that we were no longer able to do during the pandemic. Also, just to give you a couple of stats, in 2020, the average FICO score was 710. In 2021, the average FICO score was 714. So we have continued to see an increase in credit scores. And what that tells me is that, the pandemic wasn't necessarily just a fluke. We've all now been able to spend a little bit more time, be a little bit more organized, potentially re-perpetuate where those funds are going. And so slowly over time, we've continued to see an increase in credit scores. The next item here is geography. Now, geography is not a factor when your credit score is determined, but we can see based on the geography of the US that there are some differences as far as credit scores. Now, you'll typically see the southern states there have, on average, lower credit scores, and you'll see, the Pac Northwest, the Northeast have slightly higher credit scores on average. They do equate that to the cost of living in those states, the wages that people make, the amount of debt they take on, and their access to their access to be able to increase their revenue year over year. And again, it's just an average. We don't think that everyone in Texas has a poor credit score, of course not. But this is really just the average of how it's spread out throughout the US. Now, typically what we see is Minnesota has consistently had the highest credit score on average year over year. And we see that Alabama has had some of the lower credit scores year over year. Again, it's just based on averages. And so we thought it was important to really see how this was spread out across the nation. The next item I wanted to cover was really more so, why is this important, right? Why do you care about your credit score? And the reason for that is because your credit score determines the rate at which you borrow money. And the amount of interest that you are charged is going to have an increase or an impact over time as to how much you pay to borrow money. So typically speaking, the lower your credit score is, the higher interest rate you will pay. The higher your credit score is, the lower the interest rate you will pay. And the idea behind this is lenders believe if you have a higher credit score, you are more likely to pay back that loan, which means it's less risky for them. They don't need to recoup as much extra money up front. Whereas the lower your credit score is, lenders believe that means you are less likely to pay back that loan. And so therefore, they are going to charge you a higher rate because it's more risk to them to lend you that money. Now, if you take a very simple example here, we have a 30-year fixed mortgage of $200,000. If you had a credit score of about 620 to 639, you'd have about an APR, an interest rate of about 5.5%. If you had a credit score of 760 to 850, so an excellent credit score, you'd have about a 3.9% interest rate, right? So 3.9 versus 5.5. The difference over that 30-year period is about $60,000 in this example. So again, over 30 years, maybe not the biggest deal. But as you start to increase the amount of that mortgage, shorten the length of that mortgage, it becomes more and more impactful. So again, this is the reason why we want to be able to educate you on your credit score so that you can pay less over time to borrow money and help increase your generational wealth. Another great example here is saving for retirement versus reducing debt. And what you're all thinking here is this is really the conversation of, do I save for retirement or do I pay off my student loan if I don't have the ability to do both, right? And of course, there are a number of different versions of this, right? Maybe you bought a house, maybe you bought some really expensive rental property, right? Whatever the case might be. But the idea here is if you started early, right? If you started saving for retirement, and this is really just an example of compounding interest over time. If you started saving early, and in this particular example, we put away about $100 a month for 10 years, right? So at the end of those 10 years, you had about at the end of those 10 years, you had about $12,500, right? Again, just $100 a month for 10 years. And that is assuming we had a regular average standard rate of return over those 10 years. If you stopped after those 10 years, you never contributed another dollar, and you waited the additional 30 years, you would have saved about $92,000 versus your late starter, right? So maybe you didn't contribute for those 10 years. You paid down debt, you paid your student loan, you paid off your mortgage, you bought your cars, right? Whatever the case might be. If you waited, so you started after 10 years, same thing, you put $100 away a month for 10 years. At the end of that 10-year period, you would have more money. However, over time, you would have accumulated less, right? It's a difference of $30,000 starting earlier and letting it compound, or starting later and having to add more to it. So again, for us, we do feel that it's important to really weigh those characteristics. And we know that not everyone is going to be able to do both, but the idea is to really work with an advisor and figure out what makes the most sense. Maybe paying a little bit off that student loan and saving a little bit as well. The next item that I want to cover here is going to be accessing your credit report. Now, this is probably going to be one of the trickier concepts that we're going to cover throughout this presentation, but I will go very slow and really make sure that we are covering this topic to its fullest. So first and foremost, accessing your credit score. Each and every single one of us is entitled to 3 free credit reports per calendar year. We are entitled to 1 free credit report per each bureau every single calendar year. So you get 1 from Experian, 1 from Equifax, and 1 from TransUnion, completely free of charge. You can access those credit reports from the website that you see here on the slide, annualcreditreport.com. You can go to this website and you can actually decide which credit report you would like to pull at which time. Typically, what we recommend is to pull your credit report every 4 months. You can space it out over the length of that calendar year. You get 3 of them for free. So maybe do, February, May, and September or October, right? You can space them out. Now, when it comes to pulling your credit report, there are important things you need to know. First of all, when you personally pull your credit report from annualcreditreport.com, it has absolutely no impact on your credit score. You personally can pull your credit report as many times as you want. Not all of them might be free, but you can pull it as many times as you want without impacting your credit score. And that's important to know, because sometimes, depending upon who does it and how it's done, someone pulling your credit score can have a negative impact on your credit score. Now, there are two differences in how someone pulls your credit score. There's what's called a soft pull, and there's also what's called a hard pull. A soft pull, no impact on your credit score, not at all. So you, like I said, can pull your credit report as many times as you want. If you are doing a background check, so if an employer needs it for a background check, that will not impact your credit score. Any reason for someone to pull your credit score that is not associated with a line of credit will be considered a soft pull, right? So if you're not getting money lent to you, then it's considered a soft pull, which is why utility accounts are on there, right? You pay for your water. No one lends you money for your water. They send you a bill, you pay that bill. Now, for a hard pull, these are always associated with a line of credit. So if you go to buy a new car, you go to take out a student loan, you go to take out a mortgage, a credit card, those are all considered to be hard pulls, and they can negatively impact your credit score. They stay on your credit report for 2 years, so you can see them, right? If someone pulls your credit report, you can see exactly when they did it. However, it only negatively impacts your credit for 1 year. So they'll be visible on your report for 2 years, but only have that negative impact for 1 year. Now, when we talk about this negative impact, it's not a great negative impact. And what I mean by that is, as we talked about previously, and I'll go back here for us, as we talked about previously, new credit is only 10% of your overall credit score. So it only represents 10% of that overall score. So this negative impact at most can only impact that 10% of your score, right? Your new credit percentage of your score. So it's not going to be a large impact, but it is important to know, because if you are someone that's right on the cusp of moving to a better category, right? Maybe you're just about getting to 800. Maybe your credit score is, 790. Well, if you have a hard pull on that credit report, it could end up bumping you down to 785, right? So you're just getting a little bit further away from that 800. So it's not going to have huge swings, but depending upon where you fall in the range, it might impact you more or less than someone else. When it comes to a hard inquiry, you are and have the right to give permission. Technically speaking, no one, no company, no organization should be pulling your credit report without your authorization. Typically, the authorization comes in the form of a signature, but sometimes it could be verbal. For example, when you're sitting at the car dealership and they say, hey, we're going to run the numbers. Is that okay? So keep that in mind. Again, you will be able to see all of the soft and hard inquiries on your credit report. Soft inquiries will be on there and only visible to you. Hard inquiries will only be on there for 2 years and visible to others. So just be aware of those two differences. Now, here's the confusing part. When it comes to hard inquiries, what they did was they realized that it was not beneficial to consumers in certain instances. So they changed the rules up a little bit. And what I mean by that is they want to benefit you as the consumer for rate shopping, right? For being a savvy consumer and trying to get the best cost possible. So I'll give you an example of what they've done. Let's say that I need a new car, right? And I'm not really sure what car I want. I want to go to a bunch of different dealerships and I want to see, what their best offer is. So maybe I go to Toyota, maybe I go to Volkswagen, and maybe I get crazy and go to BMW, right? I want to see what all of my options are. So at each and every one of them, they're going to pull my credit and they're going to tell me, okay, well, you would need to pay X amount of dollars a month for this particular car, right? So now I know what each of those car dealerships are going to do for me. What the credit score system has done, what your FICO score has done, is they said, okay, well, what we're going to do is we are not going to hold rate shopping against you. So if you have multiple credit pulls for the same line of credit, so 3 different car companies pulled my credit report, they would all go under the same category. If you have them all in the same category within 45 days, they will count that as one inquiry. So what that means is that you can comfortably go out and rate shop and not be worried that someone pulled your credit score, 5, 6, 7 times, depending upon how much rate shopping you are doing. Same thing for mortgages, right? If you want to shop who's going to give you the best mortgage rate, you can go to multiple different banks and they'll take that one mortgage loan and tie it into one hard inquiry. But just remember, it has to be within 45 days. So if you're car shopping for 6 months, you're not going to get those same benefits, right? It's only going to be in 45 days. So keep that in mind. Don't get caught up by not letting someone pull your credit because you think it's going to negatively impact it. Because if you get a better rate, that's going to save you more money over time. So just be aware there is a big difference between soft and hard pulls, and you can also group those hard pulls together for one if they are the same type of loan within 45 days. I know that is a little bit confusing. If you have questions, we can go through it again, but hopefully that is helpful and you have a better idea as to how you can access that report and what has a negative impact on accessing that report. The next item I want to cover is really just going to be a number of different strategies that are going to help you increase your score over time, if that is your goal. So the first one here is going to be payments. Now, I know this sounds silly, right? Of course, paying your bills is going to help your credit score, but this is actually a really unique idea. So what this is saying is this is actually encouraging you to pay your bills twice a month. So what I mean by that is a lot of folks get paid bi-weekly. And so what you can do is each and every time you get paid, go into your bank account and send half your mortgage or rent payment, half your car payment, half your cell phone payment. What that does is it actually helps increase your credit score for a number of reasons. Number one, it reduces the average monthly account balance. So at any given point in time, you might only owe $500 a month versus the $1,000 a month that your rent is because you're paying it every 2 weeks. It also reduces the interest you incur. And one of the biggest items here is that it helps you be less likely to send in late payments. And I know for some of us, we don't have to worry about that at all. We're organized, we're on top of it, we never forget. But there are some folks that sometimes it just slips their mind. They have a million different things going on in their life. And so sometimes it might be something you forget, you don't have time to do, you didn't remind yourself, whatever the case might be. So it does help with a number of different items. And then again, remember, your payment history is worth 35% of your credit score. It is by far the most important factor in determining your credit score. So if you are looking to increase your score, micropayments are a really great way in order to be able to do that. And again, you can coordinate them with your paychecks so that you're sending money each and every time you get paid. Ooh. The next item here is going to be your credit utilization. And I did promise that we would talk about your credit utilization. It makes up about 30% of your overall credit score. Now, credit utilization is really just a measure of how much of your available credit you're using at any given point in time. So there's a really, really simple and easy example up on this screen here. Let's say that we have $10,000 worth of credit. I know that seems low, but it's just to keep the numbers simple, right? You have $10,000 worth of credit total. And we have a balance of $1,000. That puts our credit utilization at 10%, right? We're using 10% of our available credit. We still have $9,000 or 90% of our eligible credit available to us. So our credit utilization is 10. That is ideal. Now, ideally, you would keep your credit utilization below 30. Once it goes above 30%, it does start to have a negative impact on your credit. So you can see in this example, when they have a balance of 1,500, 15%, 2,000, 20%. Once they get to a balance of 4,000, they have a 40% credit utilization. Now you're going to start to see your credit score dip. You're going to start to see your credit score drop. Again, you can come out of this in a number of different ways. You can, of course, pay down that balance. But for some of us, that might not be an option, right? Because we are accumulating this debt because we don't have the funds to pay for it. So one of the tricks that we will give you, and of course, just be mindful, but one of the tricks that you can do is if you actually increase the amount of credit that you have access to, it can also bring down your credit utilization without you having to pay an extra dollar. Now, assuming that you could be trusted to not just go rack up more debt, what you can do here is you could say, okay, well, if I have $3,000 outstanding right now, and I can't necessarily make a big payment to get that down, what I can do is I can call my credit card companies and I can ask them to increase my balance on existing cards. Most of the time they will say yes without even asking or running a credit check. They love the idea of you spending more money on their card. But again, what this does is if my access to credit goes from 10,000 to 20,000, if I have that $3,000 loan, well, now I've just dropped my credit utilization from 30% down to 15. Same thing with 4,000, right? If my allowable credit jumps to $20,000, well, now that $4,000 only represents 20% of all of my credit access. So what I've done is I've just increased my credit score, lowered my credit utilization without making any changes, without paying any more money to the debts that I owe. So again, increasing that credit balance could have a good positive impact on your credit score. The next item is old debt. And we talked about this a little bit earlier on in the presentation. One thing we need to be careful about is closing carefully, right? So your credit history, your length of credit history makes up 15% of your credit score. So again, not as big as your credit utilization or your payment history, but 15% is a decent amount. And so we need to be really careful to not close older accounts and reset that length of credit history. We've seen this happen in the past where maybe you took out a credit card when you were 18, you got through college, you got your first job, and then you took out, a different credit card at the age of 22, 25, whatever it might be. If you close that older card, it's going to reset your length of credit history from age 18 to, age 22, age 25, whatever the next time was that you had taken out a line of credit. So be aware, it's not always beneficial to close older accounts. Make sure that you won't be resetting your length of credit history by closing those accounts. And again, it would really only necessarily need to be one account. If you opened 3 accounts when you were 18, you could close 2 of them and have absolutely no problems at all. You would just want to keep the one that says your credit started at 18. The next item here is going to be your, sorry, I can actually see it. It's going to be your new debt. Now, again, this only represents it only represents 10% of your score. And we talked about this. Hard inquiries may stay on your credit report for 2 years. These inquiries typically only impact your score for 1 year. And it's important to be able to rate shop wisely. Inquiries, again, within a 45-day window for FICO specifically, 30 days for some other agencies, but FICO specifically is 45 days. They will be grouped together. So be sure you are rate shopping because, again, it will save you money over time. There's also some interesting, more unique ideas to build credit. And these are really only going to be leveraged if you are someone that is really, really focusing on increasing their credit score. The 3 examples here are credit builder loans. So these are low interest rate loans, but you don't get the money for the loan until it's paid off. So basically you have a set payment that you're paying for a year, 2, 3 years. Once you've made all of those payments, you will get a lump sum of money for whatever that loan was worth. And again, this is just to minimize the risk of the lender, to make sure that you are paying for that loan prior to them giving it to you. There's also a secured credit card. And essentially this kind of works like a debit card mixed with a credit card. And what they require is that you put a security deposit down. So if your limit on the card is $1,000, they might require that you put $500 into that account. And so then you can use that credit card, but you already have put some money down, really as just a safety protocol for that lender. Now, the last one is probably the one we would recommend least often, but a secured personal loan allows you to really leverage up some of your assets. So a car, a savings account, pieces of furniture, a moped, whatever the case might be. But just remember, if you do this and you don't pay that loan back, whatever you've leveraged up is at risk. So again, just make sure that you are being smart and sensible before you take out some of these more riskier options. But there are options for folks that feel like they have no other options, right? There's always a couple of things available to you that you can do at any one given point in time to make sure that you have access to credit if you need it. Okay. Now, waiting it out. We did talk about this earlier, but one of the best things I think they did with our credit reports was making sure that items eventually fall off. And so what this means is that if you had a bad period of time, right? Maybe a couple years ago, you lost your job for 6 months and you had a hard time paying a couple of bills. You missed a couple of payments. Well, what this means is that you're never going to be permanently penalized for things of that nature. Eventually, everything except unpaid taxes will fall off your credit report. So late payments, foreclosures, collections, public records, and Chapter 13 bankruptcy all fall off after 7 years, which means you cannot be negatively impacted by them after 7 years. So again, if you missed one payment, just know that it will not forever torment you and follow you around. Eventually, it will fall off your credit report and it can no longer be considered in any lending decisions. The only thing that takes a little bit longer is Chapter 7 bankruptcy. And then again, as I mentioned, any unpaid taxes will always be on your credit report. And I believe your student loan is also something that will always be on your credit report and never removed. We'll see if that changes with some of the new legislation coming out. But I do believe student loans fall into that category as well. Lastly, there's something called Experian Boost. And as I mentioned before, this would really be more of a last ditch effort. I wouldn't recommend this for everyone. And the reason for that is because I do believe it's a data grab for Experian, but it does have some benefits if you meet the criteria. So if you are someone that's right on the edge with your credit score, right? And you are in the midst of taking out a car loan, buying a house, whatever the case might be, this could be a really good option. What it does is it allows you to link payments that you've been paying, but that don't typically fall under your credit report. So utility bills, cell phone payments, things of that nature. You can go on to Experian, you can link those accounts to your credit report. And what that will do is we typically see it increase your score anywhere from 10 to 30 points. Again, it's never a huge shift. So I wouldn't recommend doing it if you're not on the cusp of getting to a different level for your credit report. But it is something that can kind of boost you over to a different category. On average, I believe it's 10 to 15 points of an increase. So something to consider if you need it. Okay, now we went through a lot of these common myths and misconceptions, but after going through the presentation, I always like to just reiterate them over time. First and foremost, checking your credit hurts your score. The truth is that it doesn't hurt your score if you do it correctly. High income equals high credit. We know that income is not a factor. You can have all the money in the world. If you're not paying your bills on time, you're not going to have a good credit score. Marriage will merge your credit scores. That's not true. Joint accounts will count for both scores, but individual accounts will still be separate. So if you have a spouse that has a horrible credit score, it might make sense for you to be the one that goes on a lot of the accounts as an individual, simply because you'll get a better rate of return, right? You'll get a better interest rate, which will save you more over time. Debit and prepaid cards help builds credit. That is not true. They operate the same as cash. Even though they're plastic, they operate the same as cash. And then lastly, you start out with a perfect score. That is also incorrect. Credit is built over time. So you'll notice that someone who's 18, 25, 30, they might have a lower credit score simply because they haven't built up credit over time, right? They might only have 1 or 2 pieces of credit versus someone in their 40s or 50s that might have 15, 20, 30 pieces of credit over the length of their lifetime. Okay. Now, the future of credit, they are discussing changing from FICO 9 to FICO 10. It's important to note that typically the lenders don't make these changes for almost 12 to 18 months after they've been implemented. And what the change in this is actually positive for us as consumers. They don't want third-party collections and medical bills to really have much of a negative impact on your credit score, which I think for most folks would be very helpful. I know medical bills have had the ability to kind of pile up. And then also it's going to include the ability for you to include rental history. So if you're someone that's been renting 10, 15 years and not paying a mortgage, you're probably not getting as much credit in your credit score as others. And so they are working to change the algorithm to give you credit for that as well. So a couple of positive changes coming down the pike. Again, you really probably won't see this in practice for another 18 months. So we still have some time for it, but just wanted to give you an idea of how they kind of tweak and change these things for us as consumers. Okay, whew, we covered a lot here. So I just want to pause and open it up to any questions from the audience that we might have. I see some things in the chat. I don't know if there were any questions. If you do have a question, you should be able to unmute or use the chat. The last thing I just want to flash to you is we have this great one pager. It just really summarizes everything I went through here today, goes through how your scores are calculated, some of those common misconceptions. So Todd, we can get that out to you and you can send it to your folks as a follow-up, but we do have, kind of a condensed version of this presentation for you to take as a to-go item.
Fantastic. I think the only question we have, and maybe we can reiterate, just in case everyone did not see it, was to just kind of go through again the good practice to pay bills like a car payment, rent, or mortgage every 2 weeks as opposed to the monthly payment cycles.
Yeah, so this would really only be a recommendation for you if you are trying to increase your score. If you have a good or an excellent score, I wouldn't necessarily worry yourself with doing this. But if you have either a bad, poor, or fair credit score, this would be something that I would encourage you to utilize. And all it is paying your bills more often than once a month. So for example, if your mortgage payment is $1,000 a month, and it's due on the 15th. What they recommend that you do is on the first of the month, pay $500, right? So that you're knocking down a piece of that balance. And then on the 15th or 14th, whatever the case might be, 2 weeks later, pay the rest of that $500. And what this does is it does two really important things. It reduces that monthly account balance, which helps your credit utilization, as we talked about, in real time, right? You're lowering the amount that you owe, which increases your credit utilization. But then it also helps to reduce the amount of interest you're charged. Because basically what's happening is there's a small piece of interest, typically that's occurred each and every single day based on the value that you owe. So if you're paying a small amount, right, earlier, then the value that you owe is slightly less, which means the amount of interest that's being added is slightly less. Minuscule, but over time, it can make a big difference. Oh, Todd, I think you might be on mute.
Of course I am, because I was coughing. I apologize. I've learned so much from this when I realized one day I didn't have a perfect credit score. And I kept thinking to myself, why don't I have a perfect credit score? I make all my payments. I do all the right things. And ultimately, what I did learn mostly about was that credit utilization, because I grew up from my parents teaching me don't have debt. Yes, I didn't have debt, but I also didn't have enough available credit. And it's funny when we have these different levers that we pull in our credit. So it is understanding and improving your overall credit score. Thank you so much, Christina. It's absolutely wonderful today. I know we're right up against the hour here in a few minutes, but I wanted to thank you so much for being here. Just wonderful presentation, just so much to share and learn. And again, if anyone has any more questions, feel free to reach out to us. Or if you have any questions for Christina, please send them to us and we'll get back to you as soon as we can. Any last comments, Christina?
No, I'd just like to say thank you for having us on. I hope this was helpful. Our goal here is to really make sure that everyone has all of the information they need in order to be able to make the choices that make the most sense for them. So hopefully this was helpful. And like you said, if you have questions, send them over to you and I'd be more than happy to answer any questions that come through after.
All righty. Thank you so much, everyone. Have a great day and be well.